Greetings and welcome to the Investing for Boomers special report on the price-earnings ratio. My name is Ken Little, and I've been helping people just like you to learn to invest for many years, and I can teach you too. I've written 15 books and posted more than 650 articles online on investing. But enough about me. The price-earnings ratio is one of the most important metrics you must master. The price-earnings ratio is also known as the earnings multiple or simply the multiple. However, it's most commonly represented as PE. The PE tells you how much the market is willing to pay for each dollar of earnings. The PE is computed by dividing the current stock price by the earnings per share, EPS, for the past 12 months. Don't worry, you won't be asked to compute this from scratch. Just so you know, if a stock is selling for $20 per share, and for the last 12 months the EPS is $2, then the PE is 10. So we have a stock price which is $20 divided by an EPS of $2, which gives us a PE of 10. What this tells us is the market is willing to pay $10 per share for every $1 of earnings. Let's look at how this plays out in the real world. When you compare the PE of one stock to other stocks in the same sector, you can tell whether the market has high expectations for earnings growth or not. If the PE for the whole sector is 15, a PE ratio of 10 tells you the market expects less growth in this company's earnings compared to its peers. The PE ratio is only good when measuring a company against other companies in its sector, or looking back at the historical PE for the company. Here's another way to look at it. A stock with a PE of 10 is a better buy than a stock with a PE of 15. Why? You're only paying $10 per $1 earnings rather than $15 per $1 earnings. Of course, it's not quite that simple. Few things are, right? The problem is $1 in earnings for one company may not be the same as $1 in earnings for another company. Why? For two reasons. First, the PE uses earnings per share in the calculation, and that number is subject to accounting tricks. Two, just because a stock earned $1 per share one quarter doesn't mean it will grow or maintain those earnings in the future. There may be very good reasons to buy a stock with a PE higher than others in its sector, which is why you should never use PE or any other single metric alone to make an investment decision. Let's take a quick look at where you can find the PE ratio of a stock. In this example, I'll be using everyone's favorite, General Motors. For this example, I am using Yahoo Finance. You could also use Morningstar or one of the many other sites that list the detailed information that we'll be looking for. Over here in the far left-hand side is a quote lookup, and we'll type General Motors, the symbol for General Motors in here, and click to bring us to a summary page of some key financial numbers for General Motors. And here you see the PE ratio of 21.59 for General Motors. Now, if we move over here and go to Profile, you'll notice that Yahoo Finance has the sectors and industries broken out in a manner particular to them. The sector that the GM falls into is consumer goods. The industry is auto manufacturers major. Morningstar.com may do it a different way. Another site may do it even another way. The only thing that you need to be consistent about is that if you're comparing a stock in Yahoo Finance, that you use the sector and industry breakdown that they use so that you make sure you're getting an apples-to-apples comparison. So we'll click on the auto manufacturers major, and that brings us to a summary page for that industry. If you look over here on the far right, you will see that the price earnings for this industry is 12.7. And if you remember, our price earnings ratio for GM was 21.59. This tells us that the market has high hopes for increased earnings from General Motors. This is how you use the price earning ratio to compare a single stock with an industry group of peers. It should be noted that companies with no earnings do not have a PE. The bottom line, the PE is an important guide to evaluating stocks, but it is no magic bullet. Don't use it solely to make an investment decision. Thanks for watching, and remember, It's never too late to learn investing.